first rates. Let's get the first rates going. And the first rates are 93 points higher for the Nifty. It's a good market breadth on our hand. We've got a block deal, I think, in tips. It's the name of a company. It is not a stock market tip. 4% lower for tips, 6 million shares. You've got ILDA, another 5% higher. I rest my case, guys. I mean, I just don't know what's happening there. It's a 6-bagger in less than 6 months. Stocks don't go up like this. So trust me, this is going to end very badly. But when the story is going to end, I don't know. Then you've got IRFC up another 1%. You've got PNB, which is flying high. You've got HDFC Bank, thankfully, is bouncing back. And then you've got Zomato giving it some company. By the way, Zomato numbers have not come out. So there could be excitement ahead of those numbers. But in general, I guess the mood point for the market is that we are headed higher. And it is a bank Nifty for a change, which is supported by HDFC Bank. How delightful is that? Which is actually making all the tricks. So someone is in a mood really to buy HDFC Bank. Where was this person 2 days ago when HDFC Bank was falling? But that's markets for you. They tend to react and sometimes tend to overreact. I think the reaction on HDFC Bank was exaggerated when it fell last week. Now reasonable amount of calmness seems to be coming back. Aisha?
Just want to check in on Indiabulls Housing as well after that rights issue fundraise of about 3693 odd crore rupees, 1.5% higher, barely. Not really seeing much of a reaction out there. Lots of earnings, so let's just see what Sun Pharma is doing, because Taro has reported healthy numbers. The margins as well have risen both sequentially as well as year on year. Sun Pharma makes a dash of over 1% as we speak right now. Shriram Finance, the margins have expanded to 9%. NIMs have come in healthy at about over 5,000 crore rupees. Chola Investments as well, wherein the asset quality has seen an improvement. Piramal Enterprises, they're looking to sell their entire 20% stake in Shriram Investment. Look out for that. Signed numbers have been in line. Guidance though has been lowered, but that's pretty much at par for course. HDFC Bank, Nikunj just highlighted. LIC, remember, has got the nod to raise the stake now up to nearly 10%. Current holding stands at 5.25%. So not an immediate move. But HDFC is the stock that we should be, picking up right now. DLF as well, after that land parcel acquisition on the golf course extension, 825 crore rupees is the sum which is being talked about. They've also, reported their bookings, which have come in higher by 261%. Their margins came in at about 33.6% or so. There's IEX, which has come out with its numbers. The revenue has seen an uptick of about 15%, 1.6% higher on that stock as we speak right now. Cipla, want to check in on that stock. SBI Cards, we flagged off as to how this has been a weak set. AU Small Finance Bank as well, the asset quality has deteriorated here. And Syngene, which has cut its FY24 guidance once again. AU Small Finance, by the way, has plunged 8.25%. Syngene is down 1.25%. And SBI Card will come up for you on your screens. Just want to check in on that stock as well. That's also gapped down 4.5% as we speak. But it's not bad actually for the Nifty, about a 0.5% uptick. That's where it's currently standing at. And the Adani names holding out well, Axis Bank, Sun Pharma, HDFC Bank. So not looking all that bad, at least for the large cap universe. Stock-specific moves, of course, continue. Naresh, what's the first trade that you're looking to execute?
So continuing like the hotel pack, Lemon Tree looks like a stock which could continue in the momentum towards 150, 160. So that's a buy I would go with.
Thank you for that, Naresh. Anand Shah joins us, represents ICICI Pro AMC. Let's understand his market take. What is he betting on? We'll flash what public information which we have, his latest portfolio, which includes banks, L&T, Bharti Airtel, SBI, and very interesting metal names actually, Sharda Energy, Godavari Power. We'll talk about some of those themes, ideas, and what is he bullish on. Anand, good morning. Thank you for joining us. There are a lot of beliefs in the market, they are getting challenged, which is that HDFC Bank will always do well. FIs will always continue to buy into India. Banks will continue to grow and there will be no NPA problems. The start for this year, or start for the year, has been slightly shaky. Markets are now reacting in extremes. Bad reaction, the stock is getting pummeled. Good reaction, the markets are rewarding that stock.
Hi, Nikunj. Very good morning. And yes, I think overall, as we've been all observing, markets on an aggregate basis is very strong. But what has changed, and that's what we've been talking about, there's a trend change that a lot of things did very well between 2010 and 2020. At the same time, a lot of businesses did very badly. And the common factor there was that there was an export of deflation from China. And to that extent, consumers of goods and raw material, like the B2C businesses, did very well between 2010 and 2020. But a lot of these manufacturers did very badly, so much so that within banks also, if you see, the retail banks were resilient, but the corporate banks or the banks which lent to manufacturing allied businesses like utilities and others suffered a lot in terms of NPAs. I think that trend has changed from 2020 to 2023, even into the first month of 2024. If you see, there is a stark difference between the results of the B2C businesses which are doing extremely well. They are coming under pressure, be it margin pressure, volume growth pressure. Whereas B2B businesses which have survived 2010 to 2020, they are having sigh of relief. They're doing overall better. Even within the banks, if you see, there is more recoveries from corporate accounts and very little NPAs. But the retail side, we are seeing early signs of some stress, and obviously RBI is also sort of watchful on the same.
And if one looks at the numbers, what we got from SBI cards, that is a clear indication of which way the retail, retail borrowing trends are actually moving. So put in perspective for us, what does that mean for markets and what does that mean for banks? Because most of the banks now, they take a lot of pride in saying that we are getting more than 60 to 65% of our fresh loan growth book from retail.
So again, the retail overall is also a breakup of many things. Housing loans are doing extremely well. The secured loans are doing extremely well. I think if we hear from RBI, within the personal loans, within the unsecured loans also, there are only pockets where they are worried. It's not that generally all the unsecured loans. So to me, there has been series of benefits that have come to the banking industry. On the corporate side, we had IBC. On the retail side, we had SurfaceE, which is helping on the housing loan. The slippages are fairly controlled, and more recently, the CIBIL scorecard. So this is helping many banks to actually continue to lend to retail in a conservative fashion. So I think again, there's no 1-0. We will have to look through the segments that you're in lending to, and within what strata of the society you're lending to, where are the stresses. So a lot heterogeneous. I don't think there is one answer that all the retail loans are under stress.
Sure. So, Anand, moving away from the world of financials, where do you think when the FI money returns is going to find its way? Because for now, it seems that FIIs have clearly been eluding us. It's been a DI-led market. But clearly, it's not banks where, money is going to move in, perhaps, and looking at the fundamentals as well. Where else are they going to park their money then within the large cap pool?
So again, it's an interesting study we did. And when you see the top 100 companies, the so-called large caps, within the markets, they are dominated by consumer-facing businesses, financial services, pharmaceuticals, or for that matter, telecom and services, IT services. A lot of very little of manufacturing and manufacturing allied businesses have survived in the top 100. They have all gone below top 100, and that's where we are seeing incremental earnings growth is better and valuation is also very comfortable. So we are not surprised that there are pockets in the mid caps and small caps which is continuously attracting investors' attention, given that they're doing well on the earnings front. At the same time, the valuations are not very demanding. I think what we are observing, and again, this is no data with me, but even within the FIIs, while we are seeing continuous selling, but there is a selective buying within mid caps and small caps within manufacturing and allied businesses. I think that's where the flows that we study on the FIIs is showing.
So if I have to put a very simple question, where is value in this market? How would you address that?
I wish this is an interesting market. We don't have value per se. At the same time, there are enough earnings growth which is not making the market very expensive. So I think It's a difficult market to call the macro way, but at the micro level, we continue to maintain our stance, which we have been maintaining for last 3 years. That there are select companies within the manufacturing space which survived 2010 to 2020, and today the world needs it. Not only India needs it, because now no more China will be the factory for the world into the future. Slowly and steadily, there should be a decline uh, of, of manufactured goods exports from China, and the world will need an alternative. And I think India's own consumption also, we are looking at more Atmanirbhar, more, I would say, import substitution. So I think there are pockets in manufacturing, and then the allied businesses which support this manufacturing. Our portfolios are overweight there. Notwithstanding, they've done very well for last 3 years, but the earnings growth has supported that, and to that extent, valuations to us, again, not generally for the sectors, but for the select stocks that we own, are under demanding, and that's why we continue to maintain the position.
You've taken a big bet in metals, and metals are a global dominated sector. It does not matter what India does. What matters is that what world does, and world is not in a good shape. So, what makes you bullish on metals? Is this more like a tactical trade?
Actually, on the contrary, metals is more today investor. We are in the investment mode. We are not normally metals. You find people taking tactical calls, given it's very cyclical in nature. But I think there is a structural play here where we believe China, which is the largest manufacturer as well as the largest consumer of metals, should slowly and gradually step back. I think last year had been very difficult. We had the largest consumer of metals, which is China. We had massive slowdown there. And to that extent, it's not a great year for us. And for that matter, in the metal stocks last 1 year. But when I compare the results for 2023, FY 2024, compared to the last time when we had such a difficult situation in metals, I think they're different. And to that extent, that gives me that we will make higher highs and higher lows in terms of the profitability for these metal companies. They have deleveraged, they have become stronger, they can withstand the slowdown the way they have withstand without being, significantly under stress on the balance sheet point of view. So I think we are hopeful. India has a right place. We own raw material. We have capability to manufacture metals. And to that extent, as China takes a step back, as they focus more on environment, on green, lower emissions in their own prosperous parts of their nation where they manufacture all these metals, I think slowly and gradually we should see more stable environment for metals in times to come.
Hi, morning. Let's also get in your outlook then as to what your expectation is when it comes to the FII flows. Do you believe that, going down the line, there are going to be some particular pockets or area of interest where we will see the FIIs pour money into?
I think it's dependent a lot more on the direction which the US interest rates take. Very clearly, last couple of years have been tough. The US dollar returns have increased substantially, and to that extent, there would be obvious flows out from emerging markets into the US world and from equities to the debt, given that now US dollar itself earns a lot more. So it depends a lot. But I think the good news for Indian equity markets have been domestic investors, and within that, the SIP investors. I think that's much more stable money. We feel that generally SIP investors, provided they stay for a certain period of time, have a very pleasant experience, and to that extent, they remain into the markets for a very long term. So I think what the Indian mutual fund industry and its participants, the distributors have managed to do is to teach the Indian investors to gradually invest and be investors into the markets. I think if this continues, this is a very good supporting factor against any volatility in the FII flows.
Anand, really appreciate your time. So glad you could join us with your inputs and with your thoughts. What do we have in the market? HDFC Bank, Bandhan Bank. These are laggards from last week which are making a comeback. Even IDFC Bank, I would say, is a laggard which is making a comeback. It's a good start. Let's see if we sustain at that level, because sustainability at higher levels means that market is in a sense finding support. Arul Selvan joins us, CFO with Cholamandalam Investment Finance. Let's take a conversation forward. Good morning. Thank you for joining us. Now, AUM growth for the third quarter, this quarter, has come above your guided range. Would you be looking at revisiting your guidance now that you're growing convincingly above your range?
No, see, if it has AUM growth has actually a little bit slowed down, from 47-48% to around 36%. So it will be in the range of around 30-32% is what we take, because this is primarily because of the base effect. We spoke about it some time back also, that last year the third and fourth quarters have been good quarters. So as compared to the first and second quarter, while in absolute value we are growing, it is seemingly, it looked very fast growth in the first two quarters, whereas it has slowed down a bit in third quarter. It will look like from a growth perspective, it will slow down further in Q4, but in absolute values, it will still be going up, and we should close the year by at around 30% plus.
All right, morning. Can you also break down the momentum for us in terms of the different segments? Are there any concerns on growth ahead of the elections in any of your segments?
So in vehicle finance, the growth would be, continue to be at a moderate pace. We may not be growing aggressively on the tractor front and heavy commercials, because tractors, there has been a little bit of a stress in certain parts of the country. So in those locations, we may go slow. Heavies, because the cost of fund is increasing, and in a low yield product like heavies, we may not, grow aggressively. Used and rest of the cars and MUVs and two-wheelers, other segments we will focus in vehicle finance. LAP and home loans will grow fast because of their geographical expansion. They will grow. And in the case of CSEL, which is our unsecured portfolio, we will grow a little slower considering the regulatory forbearance on that segment. We will be slowing down on that, but it will still be a decent pace as compared to the rest of the products, because the base there is against low. In the case of SME, we will again be a little bit slower because of the again, it's a low yield product, and cost of funds, until cost of funds moderates, we will have to keep it at a little moderate growth overall, but we will clock around 30% growth is what we foresee in the for the full year this year. And next year we should go at the range of around 20 to 25%. A little early. We have to see the election results, etc., to understand where we stand at the end of this financial year.
Right. Let's also discuss the used vehicle segment, 32% of your vehicle finance portfolio. The commentary last quarter from the industry suggested muted demand given the supply issues. Has the situation improved now?
See, this is where, when you have a wide variety of products in your portfolio, it helps. So what happens is, while there is a little bit of slowdown on the new vehicle segment, used is picking up, because the price variance between the BS4, BS6 still is attractive, and so there is a large amount of used market demand for a commercial vehicle. We're trying to capitalize that. And I say used, it is a very low vintage of 5 to 6 year type of vehicle. So it has got a good potential to run another 5 to 10 years. And so we are confident that this segment will perform well. Likewise, LAP and home loan, there is a large amount of growth potential there, especially in the tier 2, tier 3 and towns where we have presence by way of our vehicle finance branches, and we are expanding there. So we see a good traction even in coming year, but we will be careful considering cost of funds and other expenses before aggressively pursuing growth.
Right, and you received an insurance broking license last year. What are your plans for scaling up this business? What kind of contribution can we expect as this matures?
See, we are selling group insurance to our customers to protect our interest also in one way, and as well as the borrowers in case of there is a unexpected circumstance happening. We were earlier doing it through our subsidiaries. Now we got the license in our name itself, so we will continue to do it. So it will increase in line with the disbursement growth, etc.
Right. So, on one hand, banks are rationing credit, while on the other, rate cycle is expected to turn. In this kind of a scenario, how is the cost of borrowing's trajectory expected to pan out?
I think from here onwards, while I may not be fully subscribing to a early rate cut, but the cost of funds may not go up from here. I think we are at the sort of a peak at the cost of funds angle, and for us, the good thing is the vehicle finance book. The yield income will continue to increase as the color of this portfolio changes with regard to slightly higher yield portfolio that we are right now doing as compared to the low yield portfolio which we were doing during the COVID period. This being a fixed rate book, that low yield book will run down, and the new book which has got a slightly higher yield will become a predominant part of the portfolio, thereby making the NIMs a little bit more positive.
Now, the last time you spoke to us, you were expecting an improvement in margins, but your NIMs have remained flat sequentially. Has the share of the repriced book not risen as per your expectations?
No, this is more a case of a slight hike in the cost of funds, considering the regulatory, intervention that came in with regard to higher risk weightages, etc. So there has been a little bit of a price expectation increasing with regard to some of the banks, and so we needed to moderate that. So this will continue. This will be corrected as we move into the Q4, and you will see the NIMs improving in the coming quarter onwards.
Right. Though overall your asset quality has improved in most of your segments despite the natural calamities in the south in recent months, is the asset quality expected to hold up well ahead of the credit cost guidance?
The asset quality can improve further a little bit again, in a few basis points as we move. Q4 will always be a better quarter compared to the rest of the year quarters in the year. So in Q4 it will improve further, and maybe it will hold or slightly lose its advantage in Q1 next year. But again, it will bounce back from the subsequent quarters thereafter. So you will see continuous improvement in asset quality, and I'm confident there's a headroom to do this improvement in our portfolio.
Really appreciate your time. Thank you for joining us. Jayant Acharya, Joint Managing Director and CEO of JSW Steel, joins us now. Mr. Acharya, good morning. Standalone volumes were lower in Q3 and they were impacted by both lower exports and muted domestic sales. Would you call it a structural weakness in the incremental demand, or it is just transient?
So just to highlight on our performance for quarter three, we have done a very strong production performance in quarter three, 6.87 million tons, which was the highest so far in JSW Steel, both in Indian and overseas operations. On the sales side, we did 6 million tons, which was quarter on quarter minus 5%, but it was 7% higher YOY. The primary reason for the drop quarter on quarter was lower export sales, because the global markets were weaker, and that's why the export numbers were weaker, and higher imports coming into India, which affected the retail sales. However, our sales to institutional customers, to OEM, industrial, was at an all-time high. Our automotive sales, our sales to the renewable industry and to the packaging was the highest in this quarter. So we maintain our focus on all our industrial and institutional customers and continue to do well in those. It's only, I think, a limited impact of the sentiment and imports, which resulted in a channel destocking in retail and a drop in exports. However, we are seeing improvement in global steel prices in the last few weeks, and that would lead to close to domestic parity on prices. So therefore, the imports are likely to go down. And it will also encourage more export volumes out of India as there is attraction in terms of prices internationally, which has gone up.
Right, morning. Now, realizations too have been muted this quarter. Steel prices since the month of October as well have been on a declining trend. Question is, where do you see steel prices headed given China's government stimulus?
So China, as we all know, on the property sector has been weaker, but the other sectors, including the infrastructure, manufacturing, renewable, etc., have done better. Automotive sales have been at an all-time high. So they have been able to balance out the shortfall in the property sector. China is providing targeted stimulus, and we are expecting more policy measures in the first half of this year, which they will take to support their economy. So that should improve some part of their domestic demand. That would reduce, therefore, the exports out of China. Having said that, I would also like to point out that the raw material prices are elevated, and therefore the margins, even with China, is under strain, and therefore we are seeing prices going up internationally. China, Europe, US, we have seen prices move up. We feel that this would be reflected in the coming months in India as well. And with a seasonally stronger quarter, we believe that India demand perspective also will do better.
Right. So that import competition that you talked about, any initial signs of a reduction in competition from imports then?
I would say that probably early days, but we are seeing the bookings have gone down because the parity, as I said, domestic steel prices are close to parity of international prices. And therefore, at this level, it may not make practical sense to import.
Right. Raw material costs too have started rising. Your standalone EBITDA per ton fell about 13% sequentially. What's the outlook then on raw material pricing trends and your spreads for the next few quarters?
Our EBITDA was 7,180 crores with EBITDA per ton of close to 12,000 rupees, 11,957 rupees per ton on a consolidated basis. Our margin stood at 17.1%. Our India operations per ton was also very similar at 11,900 rupees per ton, and not very different from our console. Our overseas operations in this quarter 3, have done quite well. And both from US and Italy perspective, they have contributed positively to the EBITDA. And that's why you're seeing a marginal uptick in the console. Indian subsidiaries overall also have done well. So from a per ton perspective, difficult to comment, but the way I would like to put it is that in quarter 4, we see that the iron ore prices and coking coal prices remain elevated, and that would increase our costs and would put pressure on the margin. However, from a volume perspective, we expect quarter 4 to be better because it's a seasonally stronger quarter. The export volumes are now picking up with better realizations. And we expect that the global steel price increase will reflect in India in the coming month to some extent. So therefore, it will partly offset the cost increase, which we are likely to see in quarter 4.
You've scaled back your capex guidance for the full year. What is the reason?
No, I have not scaled it back. I would say that if you were to look at the capex spend, because there is an election in the interim, the capex spend for one quarter may be slightly lower because there'll be an interim budget. But we see the direction of the spend being quite strong. That would continue post the elections. And the general activities of manufacturing will continue. So we'll see automotive, renewable, and other spaces being also quite strong. So I've not scaled it back. You may have a small disruption. You may have a consumption spend increase. But on the capex side, there may be some, I would say, delay during the period of the election in the interim. That's all.
Right. Now, the last time you categorically said that you will be looking at strategic assets and that you have given an EOI for NMDC Steel. What's the update here? What's the progress?
No, nothing additional information as such. I think it is more or less similar. On the coking coal side, we continue to scout for assets and are looking for assets in various parts of the world, including Canada, Australia, Mozambique, and elsewhere. We will certainly give you an update as and when we have more clarity on that.
Sure. Any interim budget expectations that you may have for the sector?
So I would say this is an interim budget, so we will have to look at it like that. But I would basically feel that the government would continue their public capex, which they have been doing on infrastructure, because that has been growing the economy quite well. A focused approach on improving manufacturing through self-reliant India, Atmanirbhar Bharat, and that has stood us in good stead. I would expect that the government will continue their focus in this direction and progress. That will continue to improve the steel consumption in the country. The per capita income is also rising with an inclusive growth, which we are seeing across India. The rural footprint now, I think, is showing some improvement. Two-wheeler sales are improving. Manrega demand has gone down a bit. While I think in terms of fast-moving consumer goods, it is still been a little slower, but I think we are still seeing pickup there. So therefore, we would expect the government to continue that track. On the import side, which you asked, I think our concern is that India is an outlier in the world today. The economic growth in India momentum is quite strong, and that is reflected in the steel consumption in India. We would like to be cautious about cheaper imports coming into India at unfair prices. And I think the government would need to probably look at those and look at appropriate measures to see that it doesn't hurt the domestic industry.
Okay. Thanks so much then for taking time out and giving us a sense as to what the outlook is, and that's really the word coming in from the management of JSW Steel. But let's get a move on, put the spotlight on the markets, and Ramdev Agarwal, the chairman and co-founder of Motilal Oswal Group, says that they're witnessing a vertical growth in the capital markets right now, saying that good returns are enticing investors to invest more capital in the markets. Listen in.
This is just about beginning of the large trend in the capital market. And it has become so acute that even banks are feeling the pinch of flight of deposits from the banks to the capital markets. So I think the experience of capital market of the larger masses is very good. I mean, if you see the return in last post-COVID particularly, from 7,500, 8,000 to almost like 3x. So I think the return is more like 20, even in the last 12 months, it is about 20%, 21% index level. If you look at mid and small, it's like 35, 40%. So I think returns are very good, and that is enticing people to come to the market. Digital onboarding is there. In 5 minutes, you can open your account and start trading. So I think that has been a fundamental shift in the capital market outlook. And it has happened after, say, 75 years. In the sense that till 2020, there were only 30, 40 million demat accounts. That too with all kinds of duplication. So unique account must have not been more than 20 million. From there to go to 140 million in December. And now as we are talking, it must be more like 144 million. And unique account must be more like 80, 90 million. So I think it's a vertical growth in the capital market. And the network effect of good experience is pulling in more money from the existing guys. And of course, new guys are also coming. And it is going deeper into 5th, 6th tier of the markets. So I think, and this money is not going to go away, mind you. Unlike in 1990 when bull run happened, that time the money came and went in 2 years' time as the scam broke. But this time, this money is for good. In fact, the money flow will become bigger as we go forward. So, and I think it has so much of power of wealth effect that it can actually increase the GDP growth of the country. You might have seen this half year, that actually RBI estimate itself was wrong by 1%.
Yeah. On such a large base, 1% is a big miss.
And all the global economies, I mean, including ours, they are off by 1.5%. They were at 6.2, 6.4, and what turned out is 7.6.
Okay, that's Ramdev Agarwal talking about what he makes of the markets right now in earnings. But Warren Harris, CEO and MD at Tata Technologies, joins in right now to talk about how their quarter was and what they expect going forward as well. Warren, great to have you on ET Now. Thanks for taking the time out and joining in. First things first, services, which is 78% of your revenues, was soft. Led by seasonality. Do you expect this weakness to get protracted into Q4 as well?
Well, the third quarter is always a soft quarter for us. We have the festivals in India and the Christmas and the New Year holiday around the world. But our services revenues in Q3 were also impacted by the transition that's going on with one of our customers in Southeast Asia. We are at the tail end of the development of 2 electric vehicles for one of our customers here, and we are transitioning from the engineering work to launch support. So headcount is reducing. We saw that commence in the second quarter. It accelerated in Q3, and we will likely be done with that transition in the fourth quarter. So that's had an impact in terms of services growth tapering. We expect some of that to continue in Q4, but given the deal wins that we've been able to celebrate and the order book that we're taking into next year, we're extremely bullish for fiscal year 2025.
Operational efficiency and lower contract drove 140 quarter-on-quarter EBITDA margin expansion for you. Now, you've talked about 200 to 250 bips expansion over medium term. Walk us through what levers do you have which could take you higher?
Yeah, we benefited in Q3 because one, business mix improved in the second quarter for that same customer that I referred to in terms of the transition. We were doing a lot of test and validation work, and that's work that we buy in from some of the testing houses around the world, and so margins on that business are lesser. We also were impacted in Q2 by the relatively generous salary increments that we rolled out. In Q3, our bought-in services and our contractor headcount went down. We've also maintained a laser-sharp focus on things like offshoring, our people pyramid, and productivity. And I think that's a reflection of the discipline that we're driving into our business, the rigor that we're driving into the business. We expect margins to incrementally improve over the course of the next 12, 18 months. I don't think you'll see a 140 basis point improvement in any one of the quarters in the next year, but we expect to incrementally drive the appropriate levers in the right direction, and I think you'll see improvement in margins, particularly over the medium to long term.
Right now, your deal wins as well have been fairly strong this quarter. What is the nature, though, of these deal wins, and which are the segments that are driving this growth?
Yeah, well, we had a very strong quarter in terms of deal wins in both automotive and in aerospace. In automotive, we had a $50 million TCV win with one of our automotive customers in the United States. They're looking to add capacity, but they're looking to add capacity in offshore locations, and so we won that deal to really build capability for them here in India. We won a $25 million TCV deal with a European aerospace OEM that's focused upon the deployment of digital tools to help them accelerate their manufacturing throughput. We won a top hat deal in China with one of the specialty vehicle manufacturers, and then we've also won a number of digital deals that are focused upon extending the integration of the tools that define the digital product with those tools that underpin the manufacturing process, and that's an area that we are developing quite a recognition around. And so we've won a couple of deals, one with a new energy vehicle company in the United States, and another with a European OEM.
Sure. You talked about the deal win in aerospace, and I believe Airbus order is also expected to ramp up well, right? Is it fair to assume that FY25 growth will be led by the aerospace vertical?
Yeah, most definitely. We've been impaneled by Airbus about 18 months ago. We've been opening up offices in Toulouse and Hamburg to complement the footprint that we've got close to the Airbus facility in the UK. We've been going through the accreditation that's required by Airbus, and at the same time, in parallel, we've been building a significant order book with Airbus, and we expect to discharge some of that this quarter. But as we go into next year, we'll really start to see a ramp up. And of course, the relationship between Airbus and the Tata Group continues to grow. Not only is Airbus partnering with the group to develop and build the C295s here in India, but I think you may have seen the helicopter announcement last week, and so that partnership continues to scale and is very strategic to both groups, and we expect that commitment to provide tailwinds for Tata Technologies.
So coming back to deals and partnership, you've signed MOUs with Intel and others. Help us understand that what this would mean for Tata Tech in the SDV space.
The deal with Agratas is a deal that really extends upstream the capabilities of Tata Technologies. We've been somewhat renowned in terms of our electric vehicle development capabilities, and we've done a lot of work in and around the integration of batteries and battery management systems. But the partnership with Agratas will focus upon pack design and the manufacturing processes associated with bringing packs to the market. So we're excited about that. The deals with Intel and ARM are incredibly strategic in the context of our software-defined vehicle ambitions. The industry is transitioning from a supply chain that is essentially controlled by the OEM to much more of an ecosystem, and some of the silicon players will have greater and greater influence over the product development process in and around mobility systems. And so the partnerships that we're establishing with some of the major players really, I think, propels Tata Technologies, to the front end of the SDV world, and positions the type of a bundle proposition that I think is going to be very meaningful, not just to the OEMs, but also to the tier ones.
All right, thanks so much for taking time out and joining in. That's the takeaway then coming in from the management of Tata Tech. How Q3 services has been weak, largely owing to seasonality. FY25 growth, though, will be led by the aviation segment and a ramp up of Airbus orders. A quick check-in as to what the rest of the market is up to, and as we're anticipating a whole host of numbers today, we're holding out steady at the 21,550 mark, and its traction as well being witnessed within the broader universe. In terms of the individual sectors, it's pretty much everything that's in the green, barring a slight cut for real estate. Energy really seems to be leading the way. Infra, PSU banks, as well as the Nifty Bank Index, that's where you're seeing a lot of traction. What's happening with some of the index heavyweights like Bajaj Finance prior to its numbers? Pull up that stock. There's NTPC, BPCL, and then of course the FMCG heavyweight ITC that will be coming out with its quarterly performance. And for the most part, a lot of those result heavyweights going in healthy, barring an ITC down 0.5% prior to its numbers at about 453. All right, let's put the spotlight then on Shriram Finance, and joining in is Umesh Revankar, the Executive Vice Chairman of the company. Thank you so much for taking time out. To begin with, let's discuss your AUM growth, because in the last 3 quarters that has been around 20%. Do you think that this year can end with a growth of 20% or maybe higher than your medium-term guidance of 50%, 15%?
Yeah, good morning. The AUM growth has been steady, especially the credit demand coming from urban and rural both, and that is really helping us. And for this year, I think 20% should be the target, even though we have given a long-term 15% CAGR growth for 3 years around the merger. But now in the first year, the credit demand being strong, we were able to grow 20%. Plus, the synergies are working out well. The synergies of merger, cross-selling of product in the branches of erstwhile Shriram Transport and Shriram City Union, now it's a merged entity, and we're able to really play it well, and it has helped the growth of the volume. Plus, we are able to also improve the margins.
Fair enough. Now, when we're looking at your loan growth, other than CV and equipment finance, it's at about 32% on a year-on-year basis. Your growth in CVs was a bit tepid. Segment-wise, how is your growth going to look at? Are there going to be any pockets where you're seeing growth could potentially moderate?
CV is something which we had indicated in the beginning itself, that we would like to grow between 12 to 15%, because if you look at the last 4 or 5 years, the new vehicle sales have not been strong, and it has been growing in the last 2 years only. And since we have a portfolio which is mostly used vehicle financing, individual vehicle operators, we did expect that it will grow between 12 to 15, and rest of the other products, especially if you look at the gold loan or two-wheeler loan or even passenger vehicle. See, what makes it different is the passenger vehicle is something which we were able to cross-sell it across all branches, and that's really holding out well. We are growing at 30% in passenger vehicle financing, but as well as gold and two-wheeler and the MSME, we are growing at 30%. So this is balancing out on how we can grow in various markets. In CV, demand also will come on a lag, because as the new vehicle sales, which has improved in the last 2 years, continues, there will be improvement in commercial vehicle financing also.
Historically, the second half is always better for CV sales, and especially the last quarter. So do you see this time that same factor could be at play, which the current quarter will be the best quarter for the year?
Yeah, you are right. Normally, the fourth quarter demand is always high, and also the government spend around this time is always peak. Around the budget and the allocation, all those things helps in the fourth quarter. And I do believe that CV sales will peak in this quarter. But still, if I look back at 2018-19 numbers, the CV sales are just on par or less than that. So I think there's still another 1 or 2 years for new CV sales to grow.
The residual stake of the Piramal Group in Shriram Group of companies, when do you see that transaction getting concluded?
It is subject to various approvals. I think we're hopeful of completing it by this financial year.
Financial year, the Piramal Group exposure to various Shriram Group of companies, that would actually be zero?
No, they still continue to be in insurance through the insurance holding companies, and they will take a call depending upon their strategic goal on what Piramal Group would like to do with their investment in insurance business.
If I look at the numbers which we are getting from, let's say, banks, which are also in the same business of CV financing, and I looked at, let's say, IndusInd Bank, there is a slowdown in their vehicle finance business. They are a big player. They are essentially like a canary in a coal mine. So don't you think that the CV business is getting slightly toppy now, where base effect has kicked in?
See, it all depends upon the segment which you are in. Since we are in the segment where individual operators are operating, we do feel with a better network, better penetration into deeper pocket, we will keep growing. I don't really see any lack of demand anyway. The used vehicle resale prices are still holding very good. You are right, because the new vehicle sales look slowed down a little, especially in the LCVs. LCV sales are flat year on year. It has not grown. But the heavy vehicle sales are still growing near to double digit, around 9%.
New norms in terms of the scrapping policy. How do you see the second-hand CV, market moving? I'm just breaking it for our viewers. Let's say if a car or diesel car today has a life of 10 years, which means after the 7th or the 8th year, the terminal value actually will come down. So the same, will that be applied in the CV business also, especially the second-hand CV business?
No, it plays out a little differently. See, the scrappage policy is already announced. There is nothing surprise now. The scrappage is going to be voluntary, not compulsory. So if there is a fitness for the vehicle, you can continue to run the vehicle even up to 20 years, whether it is a car or a vehicle. The diesel vehicle restriction has come only in Delhi because they don't want the more than 10 years old vehicle to be registered or transferred or fitness, go for a fitness beyond 10 years in Delhi. But that is not the case across the country. So whatever is the scrappage policy decision or scrappage policy wanted to make a change in the CV or in the commercial vehicle or in the diesel vehicle is already made. So I don't see any further changes into that. So unless there is more incentive for scrappage of policy on voluntary basis, there may not be a significant change in the ownership pattern.
I really appreciate your time. Thank you for joining us. What do we have? We got a very differentiated move in the banking sector. Kotak right up there, AU right there, down. HDFC Bank somewhere there. So Federal Bank is bouncing back. So we have a very interesting market setup per se, where AU is down post numbers. IndusInd Bank has bounced back after that initial drubbing it got last week post numbers. But HDFC Bank surely has stopped falling, and Kotak Mahindra Bank, when numbers were not bad at all, that one is also inching up very, very nicely. So it's turning out to be a rather decent day for the market per se.